Good afternoon, everyone. My name is John Morrissey. I'm the Recruitment Manager for Digital Learning at Cass Business School. First and foremost, thanks for taking the time out of your day to join us for our webinar, where Professor Alex Moss will examine the key drivers of global equity markets in today's changing landscape. And needless to say, in the UK, it's quite the changing landscape currently. If any of you have recently applied for a place on our MSc Global Finance, you will no doubt be familiar with Professor Moss as the course director of the program. As well as this role, Alex is also the director for Cass Business School's Real Estate Research Centre and a practitioner in his own right within the real estate industry. I will hand over to Alex in just a moment. Before I do, I will just do a little bit of the format of today's event. First, Alex will take us through his presentation, and then we will look to answer your questions at the end. You are welcome to post your questions throughout the presentation, of course, but we will attend to them at the end of the presentation. We hope that's now clear, and I will hand over to Professor Moss without further ado.
Well, thank you very much indeed for that, John, and hello to everybody. What I want to talk about really is the key drivers of global equity markets in the increasingly changing landscape we face ourselves. And what I'm going to do is illustrate with a few examples some of the concepts that you're going to be learning on the online MSc Global Finance course. So the way I'm approaching this is to look at how fund managers actually identify the key current drivers to give you a framework to put that into context. And in particular, what we're going to identify are the major macro and geopolitical risks, and then split them up into the upside and downside risks. And I'll explain that exactly what we mean by it fairly shortly. And then have a look at some current valuations and to put those into historic context and to see what the implied forecasts are, because the key thing with equity markets is always what is in the price. It's a question of what's going to happen relative to your base scenario. And we're going to talk about some of the key practical applications that you'll be able to use once you've done the course. So firstly, what are the key events that could impact capital pricing? Well, let's separate these into two categories. Firstly, we've got the risk to the upside. And secondly, we've got the risk to the downside. Now, the time frame on this can vary enormously, and that can vary between immediate, like the day after, as we saw with the EU referendum, to multi-year structural change. And an example of that would be the impact of e-commerce on shopping centres. And then we want to isolate the asset classes most exposed. Now, one thing I would say to you about this webinar, very important to note that what we're doing is we're discussing an approach to investment strategy, which is used by practitioners. We're illustrating some applications. What we're not doing is we're not providing any form of investment advice or recommendation. So in terms of the approach that we're looking at, one of the key things that we always need to do is to separate out what's the political noise and what's the political posturing. It's very easy for us to get tied up with what the latest news is coming through, particularly in the current environment. So we need to sort of separate out that political noise and isolate what the economic and financial impacts are likely to be. We also need to look at what our own inherent anchoring biases are. So in other words, we can think of that as the echo chamber syndrome. And one of the key reasons why people were surprised, certainly in the UK, about the result of the EU referendum was that they were only chatting to people of their own sort of ideas about what the likely outcome was going to be. They didn't take a sample of the entire country. And similarly, we also need to try and look at the quantum and the timing of the impact on each of the asset classes. So in other words, the risks that we see are not necessarily binary. So in other words, an outcome might be positive for some of the 11 sectors of the equity market, but not others. So changes in interest rates may be positive for some, but not others. And our starting point is going to be where are current forecasts and where are current valuations. In the previous webinar that I mentioned, we looked at UK real estate. We're now going to be looking at it in a far more generic way. So let's have a look at some of the key areas that fund managers are looking at as of now, and let's have a look at how we could determine them in terms of risk to the upside. In terms of the US economy, and I'm going to come on to the GDP forecast fairly shortly, the current basis is that we are expecting a slowdown in economic growth, But one of the key risks would be that it doesn't suffer that slowdown. In fact, it has sustained economic growth. So in other words, GDP will be far better than expected. That would be a risk to the upside. In other words, valuations would improve and equity markets would improve far greater than we currently anticipate. Similarly, at the moment, there's a lot of rhetoric around the trade wars, particularly between China and the US, and there's a possibility that that may well impact upon global GDP. The key thing that would happen is if those trade wars were to dissipate, there would be upside potential to our base forecasts. And similarly, in the case of China, the base forecast is that we're expecting a slowdown in Chinese GDP. Interestingly, what's been occurring recently is the stimulus by the government has led to a pickup in demand, and that may well continue. And that's one of the reasons behind the rally which started in December. So we're going to be looking at what would happen to that in the case that it didn't turn out as expected. Now, the next one, frankly, is probably the least likely of all these scenarios, which is that political stability would be to return to the UK and the US. But we'll put that down as a possibility to the upside. And I'm speaking at a time when Parliament, on the day when Parliament has wrested control from the government. So for the moment, I think that seems unlikely, but we'll see how that goes forward. Now, the key one in terms of the upside potential here is really related to interest rates. Now, up until, and I've got an example later on about this, but up until December, everybody's concerned that interest rates are going to rise in the US. Now, effectively, interest rates have come down. It's also worth noting that in terms of the Eurozone, which is the next point, interest rates have now turned negative again. So interest rates have come down by 55 basis points over the last 5 months, and as a result are now turned negative. That's good news in terms of funding costs, but it's also bad news in terms of the fact that it signals that the growth is weaker than anticipated. And finally, there's a technical point, which is what's called a bear squeeze. And that is a situation where people who've gone short of the equity market are forced to close their short positions, in other words, buy, which leads to a dramatic increase in the share price. And there's a very good example of this, which you should look at, which is the Volkswagen Porsche case, where Volkswagen was struggling and there are a lot of short sellers, and then Porsche came in and made an offer for the company, and those short positions had to be closed out, and that's what we call a bear squeeze. So those are the risks to the upside. The risks to the downside are broadly the mirror of that. So in other words, the US does go into recession, but actually far worse than people had even thought. The trade wars escalate. The Chinese economy actually comes to a hard landing, and we end up with a hard Brexit, etc. And interest rates rise. There could be oil price inflation, and the Eurozone goes into recession. There's two further points I'd like to make. One is that the real risk to the downside is any form of a liquidity crisis, which will be driven by probably derivatives and potentially auto loans at the moment. But as we saw in 2007, 2009, at the moment, people think that the market is perfectly well served by liquidity. There isn't a problem. But any form of liquidity crisis would be a severe risk to our downside case. And of course, the other point to note, which is that I've listed out here all the risks that we can potentially identify as of now. What we can't take into account are any risks that are unforeseen that could suddenly come over the horizon. Now, in terms of how does this all fit in and where we are now, what I've used as an example to give you here is the consensus economic forecast from Bloomberg. And in fact, all of the data I'm sourcing for today's webinar comes from Bloomberg. And the key thing to notice here is both the quantum and the trend. So we start off with the 2018 figures which have been announced, and we look at the estimates going forward. Now, in absolute terms, it would be hard to see what the problem is. However, when you look at those numbers in more detail, it's the rate of change and it's the quantum and the trend that are absolutely key. So in the case of the US, you can see the base case, and these are the consensus of external forecasts, is that GDP will slow down over the next 3 years. And as I said in the starting point, if that were to worsen, that would be a downside risk to us. In terms of the UK, what is particularly noticeable, however, is that the lower level of absolute GDP, and in addition to which GDP growth in addition to which that's technically expected to pick up in 2020, 2021. That, however, is assuming that there isn't going to be a hard Brexit. Germany, which accounts for a significant part of the Eurozone economy, as you can see, there's the reason why Eurozone rates have come down below zero. It's because of weak economic growth, but that's forecast to rebound. And in the case of China, you can see quite clearly there a very smooth linear trend down from 6.6 to 5.8% GDP. Unfortunately, markets don't tend to operate on smooth linear trends. So it's the changes to those base expectations that I'm talking about here, and that would result in a change in market pricing. So in terms of where we are now, let's have a look at some US figures because they account for a significant part of the equity market. This chart here I've taken is from 1990 to the current day, and it shows US equity market valuations in terms of the PE ratio, and that's obviously a concept you're going to be exploring quite a lot if you come onto the course. And what this shows is that the PE ratio peaked, broadly speaking, at about 26 times. So in other words, prices were 26 times earnings at the height of the first internet boom, the first TMT boom, which is the period 98 to 2002. They peaked then, and they're currently trading at about 16 times. Now that has come off quite dramatically since 2017, but the key thing to note here is that actually relative to the history, relative to the trend of US PE ratios, the market is looking a little bit expensive, but not significantly overextended as it was at the back end of 2017. Now, the next point is what's happened to US bond yields. And I'll go back even further in history for you here and look at the period from 62, I've got there actually, through to 2019. And what you can see here is effectively the long 20-plus year bull market in bonds, seeing the bond yields come down. And that was 2.6. I ran off this chart a couple of days ago. The US bond yield has now come down to 2.4. But the point about that is, again, you can see that at the time of the global financial crisis in 2008, we were looking at a normalized bond yield of 5%. It now looks unlikely that bond yields will go back to that level. And in fact, if you look at the current shape of the US yield curve, it looks extremely unlikely. So that's the equity market and the bond market current valuations. What I want to talk to you now about is something called volatility. And we measure this by a thing called the VIX index. And this looks at the level of volatility in equity markets. And one of the things that people, outsiders, tend to think is that because of this geopolitical uncertainty, that equity markets are more volatile now than indeed they've ever been. Well, in fact, this chart shows that that's not the case. And what happens is that effectively this measures it over a period of time. On a day-to-day basis, you do get these variations. But overall, what we find is that volatility, apart from the odd spike, is significantly lower than it has been historically. So post-GFC, if you look at that chart, volatility has come down. And the next point I'd like to talk about is really how do we deal with these geopolitical events? How can we get any idea about pricing and probabilities of these? Well, the good news is that Bloomberg and various other operators, but particularly Bloomberg, now comes out and you can actually track what the implied expectation of a second referendum is. And so if you look at this, you'll see that there's a 32% chance of a second referendum in the UK. That's from a low base, which is just over 20% at the beginning of the year. And that gives you a feeling and a flavour for how to translate a geopolitical event into a quantifiable amount that you can then put into forecasts. So let's have a look now at how quickly markets can change. And I've used one example here, which is US rates. I could use Euro bond rates, or I could use the equity market. They'd all be quite similar. And this shows you the tail of a 12-month period, in fact, just over 12-month period, 15 months, of US interest rates. And what that shows you is the 10-year bonds in the US. And that shows you from the beginning of 2018, when they were trading at 2.4, how they traded all the way up to 3.2 at October, November. And for those of you who are good at maths, you can understand that increase of 80 basis points on a 2.4% bond yield is a huge change. And the reason it traded up dramatically was because everybody thought that short-term rates were going to be increased 4 to 5 more times by the Fed. Subsequent to that, there's been a change in Fed policy, which you can start to see feed through in November, and the rhetoric from the Fed changed. And there's a significant drop in bond yields over that time, and they've now come all the way back down to 2.4. What does that mean? That means that your relative pricing will have changed enormously. And a lot of people say, well, how come equity markets have rallied so much? How come the bond markets have rallied so much over the last 3 months? What has actually changed? What has changed are the expectations and the forecasts. There's been a huge change in the directional trend and the absolute amount. And that is exactly why you've seen that change in equity markets and bond markets. So just briefly, where are we now? To summarize what we've been talking about. Equity markets, as I mentioned, have become significantly more sanguine in the last 3 months because of that change in the key geopolitical risks. There's been much less risk short term of an economic downturn. That may well return though, because interest rates have come lower, and that signals that effectively there's going to be lower economic activity, and therefore GDP is going to come down. The US interest rate rise has been very beneficial, but not to all sectors of the equity market, particularly those interest rate sectors such as REITs and telecoms. And in addition to which, the possibility, and I need to be careful here because I'm speaking on a Wednesday and it could all change 180 degrees by a Thursday, but the possibility of a hard Brexit appears to have receded as we speak. And in addition to which, the sharp decline in Chinese GDP appears to be inverted because of the government intervention. So as a result, these adjustments have been seen in the repricing of both the 10-year government bond yields and global equities. And because of that, the base case scenarios become more positive, which accounts for the valuation change. So that's just a brief summary and an overview of where we are in global equity markets and bond markets now. And now I'd like to hand over to questions.
Thank you very much indeed, Alex. So if you guys would like to start asking us your questions in regard to the content, Alex will be happy to answer them. And one thing actually that we did have asked by a gentleman with the name of George is, what areas of the MSc Global Finance might the content of today's presentation touch upon in terms of the modules that we cover on the program? Perhaps you can talk us through that a little.
Yes, of course. So as you know, there are 12 modules. 12 modules on the course, and this would affect bond and equity analysis, the investment strategy, derivatives and risk management, corporate finance, alternative investments. Effectively, I would say probably about 10 out of the 12. There's 1 or 2 which are slightly alternative, such as insurance, which we haven't talked about specifically, although interestingly, in the event of a global liquidity crisis, clearly the insurance sector comes up as the insurer of the last resort. So I would actually probably argue it comes across all 12 modules of the course that hopefully you'll be doing.
We've just had a question come in regards to the admissions criteria for the program as well. If we can just bring up the next slide, I'll just have this on in the background for people to be able to see, so that this will cover the admissions criteria for the program. I won't spend too much time on that, but in essence, what we're looking for would be a 2-1 or equivalent to a 2-1. If you guys are in any way, shape or form unsure as to what your degree might be to an equivalent in the UK, you can, of course, contact us and we'll be happy to let you know. But ideally, we want a 2-1 within a relevant subject area. Anything where you have a high degree of understanding of numeracy, such as engineering, perfectly fine, as is any traditional financial background as well. I just had another question come in, just be a moment or two. How is the material provided and how can we ask questions in the interim study period? if you'd like, Angelo, who's asked that, I'll be happy to talk you guys through how we use the Moodle separately. But in essence, we have a bespoke learning platform that's been designed for the delivery of the course. All of the content is available on that platform, your reading materials, your lectures, and also you have daily access to a course tutor who is your day-to-day academic contact. As well as that, every week you have two lectures with the module leader. As Alex touched upon earlier, there are 12 modules and there are 12 module leaders, our senior faculty, including Alex, who is the course director for the program, deliver a module based upon their area of specialism. So all of the content is available via the Moodle. It's not simply the case that it's provided to you in folders and you kind of work on it in that basis. Everything is built around this a bespoke platform that we've had made. And as I said, if you would like, my contact details will be appearing later on. If you'd like to contact me separately, I'll be happy to arrange some time to talk you through the means by which we have organised the Moodle to deliver the program as well. How is the assessment carried out? Alex, would you like to talk us through how for example, real estate might be assessed?
Sorry, John, Alex is muted.
Oh, apologies for that. As I say, in terms of assessments, in terms of the real estate course, the way I look at it is that the assessment is to give you an analysis of any listed real estate company globally. So it's up to you to do that. And as with the other modules, you're given all the tools and all the concepts throughout the course, and then you're asked to apply them. Some of the other modules, they have a little bit more of an academic reference to them, and you are asked to sort of provide an academic review and look at it in that context. But all of them tend to be very practical, and all of them only deal with material that's provided to you on the course.
Okay, we have another question from Angelo. Will we have access to various information platforms for historical data? Yes, you have access to not only CAS's libraries via the online library, and also if you're in London, the physical libraries as well, but you also have access to City University's libraries as well. This includes a variety of platforms that, not least our own research centres as well. Yeah, there's a whole range of content that you guys will be able to access. As well as that, obviously all the required reading and further reading for the program is often created in advance of the modules and is there ready for you guys for that content. But if there's a particular area of study that you wanted to expand upon, or if there's a particular area of interest that you have that you want to do further reading on, you have as much access to City University's libraries, research centres, data centres as any of the students that are on campus. And it's worth bearing that in mind as well, actually, if ever you guys are in London. Many of our students are actually based in London, some not more than a couple of streets away from CAS. You are more than welcome to use CAS's facilities. Your access to the facilities is exactly the same as any of the students on the campus-based programs. So in that regard, you are, you're not out of sight, out of mind. You are in all respects a fully fledged member of the CAS community. And if it's the case that we have events, MBA or alumni events in your home countries that you're able to attend, also you are free and indeed invited and encouraged to access those events as well. We very much want you to take as much of an advantage of the social aspects and the professional aspects and furthering your career whilst you're on your studies. And I think I speak for all the faculty when I say that they do actively encourage you guys to take advantage of that. The alumni network that we have here is extensive, and it's been nothing other than a benefit to the students who have completed the program. As yet, we've just had our first graduating cohort, and many of them have used the alumni network in order to develop their professional network, and in some cases managed to obtain a couple of career opportunities. I shall say no more. Okay, are there any other questions that any of you guys would like to ask in regard to any of the content or the course? Okay, well, it's often the case that you think of the best questions half an hour after the fact. So if you guys would like to contact us at any point, I'll just bring up some details for you here. You'll be able to contact either myself or my colleagues using those details. And if you are interested in regard to, oh, I do beg your pardon, a question has just come in. Could you expand a little on the career service and where graduates go to after the degree? Of course. Okay, that's come through from Martin. We have a dedicated career service at CAS. So within that, you have a careers officer who will be your point of contact while you're on the program. Now, in terms of where graduates go to, we've just had our first graduating cohort, which was in January of this year. Those were the guys who started in September 2016. Now, the exit surveys haven't been completed from them, but I have spoken to several of them, and what we've tended to see is that they've stayed within their own kind of career lane, if you will. What we have seen, though, is throughout the program is that they have had advancements or promotions within their work. One of the key things about online education, it's often the case that people say, oh, you can get a qualification while you're continuing your career. That's certainly one thing to bear in mind, but the other thing to bear in mind is that you're actually able to apply what you're learning within your career right away. So from that point of view, we hope it's the case, and it has been something that our current students have said to us, that you're able to make use of what you're being shown and hopefully make a difference to your career right away. But that's generally been the case at the moment, Martin. Obviously, when the exit surveys arrive, we'll be able to give a little bit more information in that. There is a page on the website where you are able to see a number of destinations for all of the finance programs that we offer, but Global Finance will be out in a little while. But at the moment, that tends to be the way it's gone. People often do join the course in order to try and develop a wider range of understanding of finance in order to help the career that they're currently in. And that's generally been the case at what we've seen, or people who want to transition into a finance role, maybe portfolio management or something like that. But that's what I would suggest at the moment. And can I still apply for May 2019? Indeed you can. And the deadline for applications would be April the 18th, and the course would start on April the 29th. Alex and myself work very hard to turn the applications around as quickly as possible. So you guys will have an answer usually within 48 to 72 hours. And it is the case, if you guys are in any way, shape or form unsure that whether or not you meet the entry criteria, I would encourage you to contact me. I'll be happy to field any questions that you might have. Okay, I think that's it for questions. Thank you very much, Steve, for your time, Alex. And thank you guys for taking the time to attend. We hope you enjoyed it.